Insurance Intelligence Daily Risk, RegTech, and Enterprise Market Insights. Daily AI-powered insights for insurance professionals, risk managers, and enterprise innovators. Disclaimer: this news report is for informational and commentary purposes only. It does not constitute legal, financial, medical, or official advice. Nothing herein should be seen as guidance. Any anecdotal stories are illustrative and should not be treated as advice. Commercial insurance and reinsurance. Today's commercial insurance and reinsurance markets are buoyed by strong financial performance and cautious optimism. Global insurers are reporting robust earnings, with U.S. property and casualty (P&C) carriers achieving their most profitable first quarter in decades, aided by a respite in catastrophic losses and several years of disciplined premium hikes. Analysts note that combined ratios for many major insurers fell below the 90% mark in Q1, underscoring an industry enjoying what appears to be the crest of an underwriting hard market. Investors have responded positively, pushing insurance sector stocks upward as carriers' strong balance sheets and higher interest rates lift investment income. Yet, insurers remain vigilant. Climate change is ever present in boardroom discussions, reminding executives that a single major storm or wildfire outbreak could quickly shift fortunes and test the industry's newfound profitability. Through it all, the tone is one of preparedness and innovation. The sector is using this profitable moment to invest in future resilience, advanced risk analytics, and better service for policyholders. Ensuring communities can count on their insurers even as risks evolve. The reinsurance arena is also experiencing a measured resurgence, with global reinsurers and insurance-linked investors actively deploying fresh capital. Mid-year reinsurance renewals have been marked by increased capacity and more favorable terms for insurers in some catastrophe-exposed regions, a stark turnaround from the recent years of price spikes and tightened supply. Industry reports suggest that improved loss experience in 2025, notably an unusually quiet hurricane season coupled with legal reforms in high litigation markets, has restored confidence, luring back alternative capital like catastrophe bonds and hedge fund-backed reinsurance vehicles. Major reinsurance brokers indicate that beyond near-term relief, reinsurers are doubling down on innovation. From parametric reinsurance covers triggered by specific climate indices to sophisticated risk models that incorporate climate projections and satellite data. The market's renewed appetite is apparent in deals such as a recent $2 billion-plus acquisition of a Bermuda re/insurer by a financial holding company, signaling that outside capital sees reinsurance as a growth opportunity in a world hungry for risk mitigation. This infusion of resources is a promising sign that insurers and reinsurers will have the war chest needed to backstop societies against the next wave of natural catastrophes, even those of unprecedented scale. Reinsurance leaders are not only replenishing their coffers, but also embracing technology to stay ahead of tomorrow's threats. Automation and predictive analytics are being integrated into underwriting and claims models, enabling faster responses to emerging risks, from the intensifying patterns of extreme weather to the complexities of global supply chain disruptions. As the industry invests in climate risk analytics and collaborative resilience programs, it continues to emphasize a human-centric mission, using newly strengthened finances to narrow insurance protection gaps and support communities vulnerable to disasters. Insurers and reinsurers speak of a long-term vision that goes beyond immediate profits. They see their role in forging a safer, more secure future. There's even talk of insuring tomorrow's leaps into space, hinting that the principles honed in covering hurricanes and wildfires might one day apply to off-world colonies or orbital industries. A futurist echo that underscores the sector's optimism and readiness to support human progress wherever it leads. Subtopic: Commercial Insurance and Reinsurance, Florida's Market Turnaround. One striking example of resilience in commercial insurance is Florida's recent insurance and reinsurance market turnaround. Following a 2022 legislative overhaul to curb legal system abuse and rampant claims litigation, the state's property insurers saw their combined ratio improve dramatically, averaging about 76.8% in 2025, as lawsuits dropped by roughly two-thirds and claims costs came under control. This healthier loss experience, aided by a welcome lull in hurricane activity, has boosted policyholder surplus by over 40% as companies rebuild capital reserves that were previously eroded by years of heavy storm losses and legal costs. Florida's mid-2026 reinsurance renewals have benefited, too, with capacity flooding back. Global reinsurers showed a strong appetite to expand in the state, offering more coverage at decreasing risk-adjusted prices as they regained trust in the market's fundamentals. The improved environment has even led to some stabilization or modest reduction in homeowner insurance rates, bringing long-awaited relief to Florida residents who had faced skyrocketing premiums. Experts hail this as a model of how policy reforms, disciplined underwriting, and a bit of luck with weather can restore equilibrium to a troubled insurance market. Florida's experience is boosting confidence not only locally, but across the global reinsurance community, serving as a hopeful case study in a time when climate risks elsewhere still loom large and highlighting how aligning public policy and industry practices can produce more sustainable protection for people and businesses. Insurtech and automation platforms. In the Insurtech and automation segment, a wave of renewed investor enthusiasm and technological breakthroughs is reshaping the insurance landscape from within. After a volatile few years marked by overhyped valuations and a subsequent crash in the early 2020s, the insurtech sector has emerged leaner, wiser, and more attuned to solving real industry problems. This week saw a standout fundraising headline. A fast-growing insurtech startup in San Francisco more than doubled its valuation to over $2.5 billion in a fresh $100+ million funding round, underscoring investors' appetite for AI-driven insurance platforms that promise to modernize commercial coverage and streamline workflows. Analysts note that global insurtech funding, which peaked at an exuberant $15 billion in 2021, cooled dramatically to around one-third of that in the middle of the decade, but has now stabilized and is gradually recovering. That recovery is evident in scores of new deals, dozens of funding rounds and partnerships in the past month alone across niches from digital brokers to blockchain-driven risk exchanges. There's a clear shift in strategy. Today's capital is chasing insurtech models with demonstrated traction, sustainable loss ratios, and paths to profitability, rather than just novel ideas with growth at all costs mindsets. The market's newfound discipline suggests that insurance technology is entering a more mature second act, where innovation is measured in delivered value and bottom-line impact. Established insurers are also stepping up their automation game, increasingly partnering with tech giants and startups to transform how insurance is sold, underwritten, and serviced. In Asia, for example, one of the world's largest life insurers recently announced a strategic partnership with a global cloud and AI company to develop an insurance innovation hub, aiming to embed AI-driven automation across customer service, claims handling, and risk management. Around the world, similar collaborations are fueling digital transformation, from property insurers deploying machine learning models to fine-tune pricing in real time, to health insurers using advanced analytics platforms to personalize coverage based on wellness data. This synergy between centuries-old insurance institutions and nimble, data-savvy startups is dissolving traditional boundaries. Insurance products are increasingly offered through seamless API-driven platforms, sometimes invisibly embedded in e-commerce checkouts or digital banking apps, making coverage more accessible exactly when consumers and businesses need it. The result is a new era of efficiency and customer-centric design, where not only do insurers reduce their operational costs, but policyholders benefit from faster service, on-the-fly quotes, and insurance products that integrate organically into their daily lives. The stock market reflects this evolving story of insurtech adaptation. Publicly traded insurtech firms that survived the initial shakeout have seen their shares begin to recover as they demonstrate improved fundamentals. One life insurance platform that went public earlier this year, one of the first sizable tech IPOs in 2026, debuted at a scaled-down valuation of around $1 billion, reflecting the sector's reset. But even without the first-day pop of a tech boom IPO, the company's achievement of profitability and steady revenue growth signaled a turning point. Investors are once again willing to bet on insurance tech models that prove they can combine innovation with sustainable business models. As venture capital flows back into the sector, the balance has tipped towards companies building insurance infrastructure, behind-the-scenes full-stack digital policy administration systems, no-code claims automation, and AI-enhanced underwriting engines, rather than those trying to upend the industry outright. The aim is to augment the capabilities of incumbent insurers, not replace them. This cooperative approach has unleashed a wave of creative solutions, from virtual claims adjusters that use computer vision to settle auto accidents within minutes, to robotic process automation bots freeing up human agents for high-value advisory tasks. The futurist streak in insurance technology remains as alive as ever. Some visionaries hint that the AI and automation we refine today may even underpin how spacefaring societies manage risk tomorrow. Yet the excitement is now tempered with pragmatism. Success will belong to those insurtech ventures and legacy insurers that marry visionary tech with real-world execution, ushering in an era of growth that's as sustainable as it is transformative. Subtopic: Insurtech and Automation Platforms, Digital Insurance's Second Act. Within the Insurtech revival, experts highlight a pivotal shift from early disruption to deep collaboration. Many of the flashy direct-to-consumer startups of a few years ago have evolved into enterprise technology enablers, offering platforms and software that help traditional insurers innovate faster instead of trying to displace them outright. This more sustainable second act of Insurtech is seeing incumbent insurance companies license cloud-based policy administration systems, AI underwriting engines, and low-code automation tools from the very startups that once aspired to compete against them. Dedicated Insurtech venture investors and corporate backers are now focusing on companies with real revenue and realistic paths to profitability. Global Insurtech funding, which plunged by over 70% after 2021, has now settled into a healthier pace around $5 billion annually, concentrated in later-stage companies that survived the funding drought and matured their business models. This renewal is fostering an ecosystem where technology-driven innovation becomes a shared pursuit rather than a zero-sum game. Incumbents gain agility and improved customer experiences, while tech firms gain scale, data, and distribution. The payoff is visible in improving combined ratios and customer retention for carriers adopting these solutions, evidenced by case studies in telematics-enabled auto insurance and instant small business coverage platforms. Industry leaders say this collaborative model ensures that technological progress truly benefits policyholders, cutting red tape, slashing wait times, and closing coverage gaps, while preserving the stability and trust that century-old insurance brands provide. It's a hopeful sign that as insurance technology enters a new frontier, it's doing so hand-in-hand with the people and institutions it aims to serve. Risk and compliance software. In an era of rapid innovation and ever more intricate risks, risk management and compliance software has become a critical backbone of the insurance and financial services industry. Across 2026, regulators worldwide have sharpened their focus on how insurers manage everything from cybersecurity and privacy to climate exposures, sparking a surge in demand for advanced RegTech and risk analytics platforms to keep companies in step with evolving rules. Global spending on regulatory technology is projected to top $130 billion this year, a nearly fourfold jump from the mid-2020s, as insurers integrate compliance into their digital transformation playbooks. The NAIC and international regulators are rolling out new frameworks that require near real-time reporting of risk metrics, more granular data on solvency and capital, and strict governance over the use of AI in insurance. This regulatory momentum has made compliance capabilities a point of competitive differentiation. Insurers with sophisticated risk monitoring systems not only avoid hefty fines and reputational damage, they also gain trust among customers and investors. The pressure is on carriers and brokers to adopt next-generation compliance software that can automatically track regulatory changes, monitor internal controls, and generate transparency reports, ultimately enabling management to navigate the complex maze of global insurance regulations with confidence and agility. Insurance leaders are reacting by embedding risk and compliance considerations at every level of technology deployment, breaking down silos between compliance officers and IT departments. Modern governance, risk and compliance, GRC, platforms, often cloud-based and infused with AI, are helping firms continuously scan for regulatory changes, streamline audits, and ensure internal policies are followed. For example, a number of insurers have implemented integrated solvency management software that automatically projects capital requirements under multiple regulatory regimes. From Solvency II in Europe to RBC benchmarks in the US, helping companies optimize capital buffers without breaching any requirements. Meanwhile, across the Atlantic, European insurers are adapting to new digital resilience mandates. EU regulators have enacted strict rules like the Digital Operational Resilience Act, DORA, requiring firms to fortify IT systems and vet suppliers for cybersecurity, spurring a cascading effect of compliance upgrades. Similarly, with global climate risk disclosure standards emerging, such as those by the International Sustainability Standards Board, insurers need to capture detailed environmental risk data across their portfolios, prompting partnerships with climate analytics firms and new reporting modules in their risk software. M&A activity in this space is heating up as large software vendors and consulting firms acquire specialized RegTech startups that can complement their offerings in areas like algorithmic auditing, anti-fraud compliance, and anti-money laundering (AML) checks for insurance products. By uniting these capabilities under one roof, insurance companies are trying to achieve a 360-degree view of risk, financial, operational, and technological, so they can quickly respond to any compliance flashpoints and maintain solid footing in the eyes of regulators and rating agencies. Behind the scenes, risk and compliance software is being supercharged by artificial intelligence to manage the avalanche of data and complexity. Insurers are training AI to detect anomalies in financial transactions that might indicate compliance issues or fraud, essentially giving compliance teams an around-the-clock digital ally. However, this introduces new challenges. Regulatory bodies are also scrutinizing the algorithms themselves, demanding transparency and fairness. This convergence of risk management and cutting-edge tech has a silver lining. It's driving a culture of responsible innovation across the industry. Insurers speak of prioritizing trust and ethics in technology use. They are proactively building guardrails to ensure AI-fueled decision systems can be audited, explained, and corrected if needed. For customers and society, all these initiatives aim to ensure that financial institutions remain stable and accountable, even as they become more automated and data-driven. A particularly human-centric outcome of advanced compliance software is the reduction of mistakes and crises. By catching potential issues early, insurers can prevent costly solvency problems or consumer harm, safeguarding people's policies and financial well-being. From the vantage point of 2026, the insurance industry's devotion to stronger compliance and risk software is laying foundations not only for immediate regulatory peace of mind, but perhaps even a framework robust enough to govern risk when humanity ventures to new domains, think space tourism insurance or off-planet asset protection, illustrating how seriously this industry takes its stewardship of trust well into the future. Subtopic: Risk and Compliance Software, AI Governance and Transparency. As artificial intelligence becomes increasingly woven into insurance operations, regulators and insurers are doubling down on AI governance and transparency within risk and compliance systems. Leading insurers now design their automation platforms with built-in compliance checks and audit trails to meet stringent requirements that algorithmic decisions, whether in underwriting or claims, be explainable and fair. Executives emphasize the need for human oversight. Even as AI speeds up routine processes, companies maintain human-in-the-loop protocols for critical or complex decisions, ensuring that automated systems augment rather than overrule sound judgment. This focus on explainability is driven by concerns over black box algorithms that could inadvertently create bias or errors. By 2026, several jurisdictions require insurers to document precisely how their AI models make decisions about pricing or claim approvals. Risk management software now often includes features for model validation, bias detection, and compliance logging, enabling companies to demonstrate to regulators that their AI is trustworthy and well-controlled. The result is a balancing act. Insurers strive to harness the power of advanced analytics and machine learning for efficiency and personalized service, but they are also meticulously aligning their tech innovations with ethical standards, privacy laws, and consumer protection mandates. This approach not only averts potential regulatory penalties, it fosters deeper customer trust in the digital age, reassuring policyholders that even as insurers innovate, transparency and accountability remain paramount. Actuarial and data analytics solutions. The actuarial science and insurance analytics realm is in the midst of a profound transformation as data-driven tools reshape how insurers measure and manage risk. Traditional actuarial models are being turbocharged by big data and artificial intelligence, enabling risk forecasts that are both more granular and more dynamic than ever before. The industry has now largely moved beyond pilot projects. 2026 is witnessing widespread deployment of advanced analytics at scale across underwriting, pricing, and reserving functions. A recent survey of North American insurance executives found that nearly 80% of P&C carriers are using advanced rating and pricing models, essentially universal adoption, and increasingly applying machine learning to identify risk patterns that were invisible a few years ago. Generative AI and large language models, LLMs, which were experimental in the early 2020s, are quietly becoming part of everyday operations. More than half of insurers now report using LLMs in some capacity for tasks like policy servicing and document analysis, and many plan to integrate these technologies deeper into underwriting and customer interactions in the next 2 years. The result is an industry harnessing technology not just to improve its bottom line, but to create more responsive and personalized insurance products. For customers, these data and AI-driven solutions promise fairer pricing, better alignment of premiums to actual risk, and faster, more proactive service. From real-time driver feedback in auto insurance to early detection of emerging health risks in life coverage. And while these tools are complex, actuaries remain at the helm to ensure the outputs align with reality, regulatory standards, and ethical norms, solidifying a people-driven approach in a tech-enhanced practice. Perhaps most telling is the measurable financial impact that advanced analytics are delivering. Insurers who embraced predictive modeling and data science early are reaping rewards in profitability and growth, validating years of tech investment. A prominent industry study released this spring revealed that carriers deploying sophisticated analytics tools achieved combined loss ratios that were roughly 6 percentage points better than those of less tech-enabled peers over the past 2 years, alongside a 3% higher premium growth rate. Improvements initially seen in personal auto and homeowners lines, like using telematics data to set rates or aerial imagery to refine property risk, are now mirrored across commercial insurance, life insurance, and even specialty lines. Actuaries have become strategic data stewards, leveraging everything from real-time IoT sensor feeds to advanced simulation models that test portfolios against myriad scenarios. These enhancements contribute not only to insurer profitability, but also to greater financial stability for the market, which is a boon to customers in the long run. Policyholders can have more confidence that their insurer can weather storms, literal and figurative, and pay claims promptly. With new tools come new tasks for actuarial teams, who are evolving from number crunchers to strategic risk architects and tech-savvy innovators. Many insurers are investing in expanding their in-house analytics talent, training actuaries in coding, machine learning, and data storytelling so that they can interpret complex model outputs and advise underwriters and executives effectively. There's a recognition that human expertise remains essential. Actuaries serve as a critical bridge between raw algorithms and real-world judgment. They validate that AI-augmented pricing models are not introducing hidden biases or unsound assumptions, and they refine them to navigate regulatory demands for transparency. This combination of human wisdom and artificial intelligence is shaping a future-looking insurance industry capable of tackling previously unimagined challenges. Some actuaries even engage in forward-thinking exercises like modeling the insurance implications of space tourism and lunar colonization, signifying how far their purview might extend as society tackles new frontiers. Back here on Earth, the emphasis is on ensuring these analytics translate into tangible value, better loss prevention, more resilient insurance portfolios, and products tailored to customers' evolving needs. The underlying sentiment is hopeful. With advanced analytics, insurers can protect more people more effectively, turning torrents of data into a bulwark against uncertainty and a catalyst for positive change. Subtopic: Actuarial and Analytics Solutions. Analytics Payoffs and Cultural Shift. Actuaries and data scientists are now proving the ROI of advanced analytics, reflecting an inflection point in insurance management. A key industry survey published in 2026 confirmed that P&C insurers, which heavily invested in predictive analytics and AI tools, have begun to see substantial returns. These forward-thinking carriers reduced their combined ratios by several points and achieved measurably higher premium growth compared to their less analytics-savvy competitors. It's a compelling business case that's appending old doubts. What was once experimental is now directly boosting profits and competitiveness. Notably, predictive pricing models are virtually universal at this stage, as even mid-sized insurers adopt machine learning algorithms for underwriting precision, marking the end of one-size-fits-all pricing practices. Moreover, where adoption had lagged, like claims management, insurers are now moving quickly. Automated fraud detection and straight-through claims processing driven by AI are set to triple in use by 2028, making what was fringe technology a core necessity. Achieving these gains hasn't been without challenges. Industry surveys show data quality and IT integration remain pain points, leading insurers to double down on foundational tasks, cleaning up legacy data and modernizing core systems to handle the proliferation of new analytics. To truly reap the benefits, firms are also building an analytics-driven culture, investing in continuous training for actuaries and underwriters, and aligning incentives to ensure that insights from these new tools are actually used in decisions. The transformation is as much human as it is technological, and it's being guided by a shared goal: to harness data-driven foresight in service of greater stability and security for customers and communities, reinforcing the human mission at the heart of insurance. Cyber insurance and resilience consulting. Cyber insurance continues to be one of the fastest growing and most rapidly evolving segments of the industry as businesses scramble to address unrelenting digital threats. By 2026, global cyber insurance premiums are estimated to exceed $16 billion, with double-digit annual growth propelled by the ever-expanding scale of cyber risks. However, the market's trajectory has not been a straight line. After the frenzied hard market of early decade, when ransomware and data breach losses drove premiums up by triple-digit percentages, 2025 saw the first signs of cooling with modest premium declines as new competitors entered and companies hardened their defenses. Industry insiders caution that this respite may be short-lived. The frequency of cyber incidents, from supply chain hacks to AI-enabled phishing waves, jumped significantly in the past year, hinting that insurers might need to raise rates again to keep pace with higher claim costs. Indeed, some experts forecast a renewed climb in cyber insurance pricing through late 2026, potentially averaging 15 to 20% increases if loss ratios creep upward due to big attacks or litigation costs. At the same time, more businesses than ever are seeking coverage. Surveys show cyber policy uptake is above 60% among large enterprises and growing among mid-sized firms, though insurance penetration in the small business segment remains relatively low. Insurers are working to shrink that gap, offering streamlined cyber products and raising awareness that even smaller companies need protection in an age when a single data breach or ransomware event can cripple operations. Through all these shifts, the overarching theme is resilience. Carriers and brokers are not only indemnifying clients against losses, they are actively helping them avoid losses in the first place, which is both a noble pursuit and essential to keeping cyber insurance viable over the long run. Resilience consulting has emerged as a vital companion to cyber insurance, with insurers, brokers, and specialist tech firms providing proactive services to help companies manage digital risks. Policyholders no longer just buy a policy, they often get access to a suite of risk mitigation tools and expertise. Leading cyber insurers now routinely assist clients with cybersecurity assessments, employee training on phishing awareness, and round-the-clock threat monitoring as part of the coverage package, addressing issues before they turn into costly claims. This consultative approach is transforming the insurer-client relationship from a mere transactional one to a partnership focused on risk prevention and continuity planning. Recent high-profile cyber incidents, such as multi-million-dollar ransomware attacks on critical infrastructure and data breaches affecting millions of consumers, have galvanized corporate directors and risk managers to treat cyber resilience as a strategic priority. In response, insurers are becoming trusted advisors, simulating attack scenarios with clients and advising on best practices for incident response, patch management, and recovery planning. This model not only reduces claims by mitigating losses, but also helps insurers differentiate themselves in a competitive market. It's a win-win. Businesses bolster their defenses and can often earn lower premiums for demonstrably improving their security posture, while insurers benefit from reduced exposure and stronger long-term relationships. As digital networks extend from factory floors to remote offices and even into space, where satellites and off-world assets become targets of cyber threats, this broad notion of resilience consulting hints at the future of insurance. One where protecting clients extends far beyond financial indemnity, encompassing an active role in safeguarding our interconnected world. The cyber insurance ecosystem is also grappling with an issue unique among insurance lines: the potential for truly systemic events that could affect thousands of policyholders at once. This has sparked deep conversations in 2026 about how to ensure the market stability if a worst-case scenario, say, an attack on a major cloud service provider or global payment system, were to occur. One promising development is the concept of public-private partnerships to backstop extreme cyber catastrophes. Industry and government leaders in the U.S. have been exploring a federal cyber insurance backstop, akin to the terrorism risk insurance program established after September 11th, which would provide a safety net for insurers in case of a digital catastrophe too large for the private market to bear alone. Similarly, European regulators are discussing cross-border solutions for dealing with pan-European cyber crises. Proponents of these measures suggest they could give insurers greater confidence to expand capacity and keep policies affordable, knowing that a tail risk is shared with the government. Meanwhile, some insurers are banding together in industry pools to spread cyber risk and collectively fund research into cyber risk modeling, which remains a moving target given hackers' constantly evolving tactics. While no formal global program is in place yet, the mere fact these conversations are happening at the highest policy levels indicates how critical cyber resilience is now deemed, not just for companies, but for the stability of economies and even the well-being of societies. This momentum toward collaborative solutions and smarter risk modeling speaks to a prevailing optimism that through innovation and partnership, we can manage even the starkest New Age threats, preserving confidence as we venture into a future defined by digital interdependence. Subtopic: Cyber insurance and resilience consulting, government backstops, and systemic cyber risk. In both insurance boardrooms and government corridors, the prospect of catastrophic cyber events is driving discussions about new safety nets. By mid-2026, policymakers in the United States are actively debating a federal cyber insurance backstop, a mechanism where the government would step in to cover extreme losses if a cyber attack surpasses insurers' financial capacity to pay claims. The idea, championed by some industry leaders and security experts, is modeled after earlier public-private risk-sharing programs for events like terrorism and floods. European regulators are also exploring similar frameworks as they recognize that a truly widespread cyber event, be it a massive cloud outage or a state-sponsored attack on critical infrastructure, could simultaneously hit countless businesses and insurers across multiple countries. Proponents of such backstop arrangements argue that they would stabilize the insurance market by preventing insurer insolvencies, encouraging more underwriters to offer cyber cover without fear of existential losses, and ensuring that victims of catastrophic attacks receive timely compensation. At the same time, voices of caution that any government support must be carefully structured to avoid moral hazard, ensuring that companies don't become complacent about their own cybersecurity simply because a backstop exists. The ongoing debate underscores an essential truth. Cyber risk has become a matter of national resilience, not just a niche concern for IT departments. It's a testament to how critical and interwoven our digital systems are, and how both insurers and governments are preparing together to support and protect society in the face of unpredictable, but potentially calamitous cyber threats. Headline: Title and Hook Insurance Intelligence Daily Risk, RegTech and Enterprise Market Insights, InsurTech Comeback and Record Profits in a New Era of Risk. Video description: YouTube. Join us for Insurance Intelligence Daily, where we deliver today's most important news and analysis across the insurance, insurtech, risk management, and cyber risk industries.